Hello, my dear students. Let's add value to your knowledge account today. I'm Dr. Bharathi Sunil. Welcome to today's topic, accounting principles. Have you ever wondered how businesses keep their financial records accurately and trustworthy? In this video, we'll break down the essential accounting principles that serve as the backbone of every successful business, whether you are a student, entrepreneur, or just curious. Understanding these accounting principles will give you the confidence to navigate the world of finance with ease. Here, I would like to give an example by taking students into the picture. Students, picture yourself managing your monthly budget. Say you are getting some fixed amount from your home, and also you are doing some part-time job. From that part-time job, you are getting some income. So what is your income here? Whatever the money you are receiving from your home and also the part-time job income, right? And with this income, you have to cover your rent, food, books, and also you want to have some fun with your friends, no? So for that also you need amount. So for all these expenses, you need to cover only from your income. So to avoid running out of money, what you should do, you should track all your amounts, whatever you're spending, and you have to match every time with your earnings. Just like business, how businesses matches their incomes and expenses, in the same way you have to match your expenses and income. So by following accounting principles, you have to make sure that your expenses, whatever you are making, that are money measured. Means whatever the amounts we are spending, only that will take into consideration. Means non-money transactions we will not take into consideration when you want to check your budget matching, right? So what concept we are applying here? Money measurement concept. You have to keep your personal amount separately and the group project funds separately. That means you are applying here business entity concept. You should not mix your personal amount with project fund amount. Why? Because personal amount is only for your personal spending. But the project fund amount is to be spent among all the students who are doing project collectively. Right? Next, whatever the expenses you are making and whatever you are receiving, that you have to write in books. So that these two should match. Means your expenses should match with your income. Right? So this is called what concept? Dual aspect concept. Like this, simple principles help you to stay organized and make smart choices with your money, just like professional accountants do for their companies. Let's go into the topic. Accounting principles. What are accounting principles? The rules of conduct or procedures that are adopted by the accountants universally while recording their accounting transactions. As an accountant has to follow some rules of conduct or procedures which are universally adopted by all the accountants in all the companies. So this will have some uniformity in the accounting procedures. These accounting principles are divided into accounting concepts and accounting conventions. So accounting concepts and conventions are the basic rules or the guidelines which are to be followed by all the accountants to record and report their financial transactions accurately and more consistently. What is accounting concept? It's a basic rule or idea for recording all our business transactions into our books. And what are accounting conventions? These are our usual practices, whatever we adopt. When there are no clear rules about any accounting procedures, then we will follow our conventions, whatever are followed by our traditional accountants. When clear rules are not framed, then what is our usual practice? We practice whatever our traditional accountants followed as customer usage. Accounting concepts and conventions are required because we have to see that our financial statements are clear, accurate, and useful for everyone who reads them. What are accounting concepts? Accounting concepts are the simple basic ideas or rules. The businesses have to follow this to keep their financial records more clear, consistent, and meaningful. There are 10 accounting concepts. Each and every concept we'll discuss in clear. First is business entity concept. Let's discuss this business entity concept. Here, business is separate and owner is separate. Though owner started this business with his own money, when the business got started, owner is separate and business is separate. Whatever the owner is investing in the business, that amount is called capital. So proprietor is regarded as creditor for capital. So business has to pay that money to proprietor. Once proprietor invested his money into the business, he is completely different and business is completely different. If at all proprietor wants to withdraw any money from his business, he can withdraw only as a loan and he has to pay that money with interest to the business. His money withdrawal is called drawings. When proprietor is withdrawing money from the business, proprietor will become debtor to the business because this amount is to be paid back to the business by the proprietor with interest. But when proprietor is investing money in the business is considering that amount as capital and business will pay proprietor interest on capital for the amount whatever he invested in the business. So for example, I'm having one business. That business is Bharathi Jewelers. Say, when I have invested my money in the jewelry business, Bharathi is separate and Bharathi Jewelers is separate. If at all I want to take any money from jewelry business, I can take only as a loan and have to repay that amount with interest. If I want to take any jewelry, then also I am considered as a customer here. I am not considered as a owner. Even I have to pay money to my business. Second one, dual aspect concept. This is also called accounting equation concept or balance sheet concept. So what is dual aspect concept? Every business transaction is resulting in receiving of some benefit and giving of some benefit. Say for example, we have purchased some furniture. Okay. So how we have purchased? By paying cash. So when we have purchased furniture is coming into business and what we are paying? We are paying cash. So if you have purchased 50 lakhs worth of furniture, we have to pay 50 lakhs rupees as payment, right? What we are receiving? 50 lakhs worth of furniture and what we are paying? 50 lakhs rupees of cash. So this is called what? Dual aspect. Means for every debit, there is a corresponding credit. So what is the entry here? Furniture account debtor to cash account. Now, accounting equation concept or balance sheet concept. Capital plus liabilities is equal to asset. In balance sheet, we'll have liabilities column and assets column. Liabilities column consists of capital and other liabilities. So, if you take balance sheet, liability side if it is 5 lakhs, asset side also it should be 5 lakhs. So, both sides it should be equal, right? So, capital plus liabilities is equal to assets. So what is capital? Whatever is invested by the owner of the business or shareholders is called capital. So how much is that? 3 lakhs. And the liabilities means if you have taken any loans from the banker or you have purchased some goods on credit basis. So all that will come under liabilities. So 3 lakhs is our capital, whatever is received by the business plus 2 lakhs liabilities. So 3 lakhs plus 2 lakhs is equal to 5 lakhs. So whatever we are raising, either in the form of capital or liabilities, that will be used to buy our assets or to use for our assets. So we can see here, capital is equal to assets minus liabilities. You are given one question in your exam. Find out capital when assets and liabilities amounts are given. So how you will find out your capital? We will write assets minus liabilities. So what is our assets amount? 5 lakhs. And what is our liabilities amount? 2 lakhs. So 5 lakhs minus 2 lakhs is equal to our capital amount. Next, going concern concept. Whenever we start any business, we always wish that our business should live for a longer period, right? So it will, any business you take will start with our wish that it should continue for a longer period. Any business can continue for a longer period unless and until it is dissolved by us. So what is this concept called? Going concern concept. Say for example, if 10,000 people are traveling in a big ship, and who are the people traveling in the big ship are all belonging to only one company. Because of some natural calamity or something, the ship got drawn into water. So all the 10,000 people got died. Now you tell me whether the business will continue now or not. So what is your answer? Yes or no? The business will continue or not? It will not continue when all the people of the business got died. Business will continue. Why? Because business is artificial person created by law. Whether all the members of the business got died also, it will not have any impact on the business, because business is artificial person created by law. This business can only be closed when it is closed by law. Is it clear? So what is going concern concept? A business will run for a longer period until and unless it is dissolved, it can't be closed. Because business is not a natural person, it is artificial person created by law. Next, accounting period concept. Just now we have discussed that business is for a longer period. So now when we have started business, generally we all will have interest whether we are making profits or losses, what are our assets and what are our liabilities. Yes. So what we'll do, we have to maintain records, and every interval we should know what are our profits and what are our losses, or what are our assets or what are our liabilities. So what is that period of interval? That is 1 year. That means 12 months. Means after every 12 months, we will do our accounts closing. Say for example, you have taken admission into nursery. From nursery to graduation, how many years? Say 17 years. Say for example, if your educational system is like that, you will be given your academic performance only after 17 years. Is it nice? No, you can't understand how I am performing in my class or where I have to get myself improved. Right? So in the same way, every year we have to know what are our profits, what are our losses. If there is any loss in any business, then what we can do, we can see that some measures are taken to improve ourselves to get profits in the future. Right? That is why accounting period concept is required. What I said, accounting period is 12 months. Generally, all the businesses will have April 1st to March 31st. But in some places, some people follow Diwali to Diwali, or Dashera to Dashera, or some business also follow January 1st to December 31st. But whatever they want to follow, but it should consist of how many months? 12 months period. Suppose if you are taking accounting year as January 1st to December 31st. Say you are opening books on January 1st and you are closing books on December 31st. So your accounting year is 2024. January 1st, 2024 to December 31st, 2024. So only 2024 we are taking. If you are taking financial year, then April 1st, 2024 to March 31st, 2025. That means we are opening books on April 1st, 2024 and we are closing books on March 31st, 2025. Is it clear? Next, cost concept. What is cost concept? We record all our assets. Say for example, we have purchased machinery, or you have purchased car, you have purchased any asset in your business. All those assets we have to record only based on their cost price, but not at their current market price. For example, a company bought one machinery for rupees 10 lakhs in 2020 year. This machinery we can use for 5 years. So what is the value of that machinery? 10 lakhs. And for how many years we can use? For 5 years. So 10 lakhs divided by 5 years. So how much you will get? 2 lakhs. Every year our asset value will be decreased by 2 lakhs as depreciation. So for the first year, 10 lakhs minus 2 lakhs, it will be 8 lakhs. Next again, minus 2 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 lakhs. Finally, at the end of the 5th year, the measuring value will be 0. So in this way, we'll show our measuring in our business accounts. Every year, whatever the value is there in the books, from that we will decrease our depreciation. So what you have understood in cost concept, we have to record all assets as per the cost price, but not as per the market price. Next, money measurement concept. As you all know, we'll take only financial transactions whenever we are recording into our books. We'll not take any non-financial transaction. So if you take one doctor's example, if he is charging 1,000 rupees from one patient, so it is measurable. How much time he is spending on each patient, how much care he is taking, we are not measuring. Financial accounts only requires how much fees he is charging from each patient. So for example, when we go to any market, we purchase bananas. So what is the cost of 1 dozen of bananas? Say 60 rupees. So at what rate you have purchased your bananas? 60 rupees. So you will enter into our books. But suppose somebody donated you some fruits on the occasion of some festival or something else. You can't enter that into your books. Why? Because those are non-financial transactions. Where money is involved, only the transactions are called financial transactions. Where money is not involved, the transactions are not called financial transactions. We'll take into consideration only those transactions where amount, payment or receipt are involved. We'll not take into consideration where any financial dealing is not made. For example, if your business buys one computer worth rupees 50,000, then immediately the company will record into the business accounts, right? Because it is having some specific monetary value. But non-financial matters like if the employees are very much skilled and the company is very good in motivating its employee, or the company's reputation is very good, or customers are having good satisfaction about the company's services or products, all those will not record into our books. Why? Because we can't measure that. So whatever the transactions we can measure in terms of money, only we will enter into our books. Which we can't measure in terms of money, we will not enter into our books. This is about money measurement concept. Next, realization concept. What is realization concept? Any business you take as example that should record revenue only when it has actually earned it. That is, when it has delivered goods or provided services to the customer. So for example, we have received one order from our customer to deliver 10,000 kgs of sugar, right? So when you have received that order on April 1st, 2024, right? But we have delivered that on 30th. So when we have to take into our accounts, not on the date of order we have received, but on the day when we have delivered our goods, that is June 30th, 2024. We have delivered those goods under the assumption that we will receive that amount. Whether that amount is received in this year or will be receiving in the next year or will not receive also because of bad debts. We have to record in our books that we have earned revenue only on the date of delivery of goods or the date of services we have rendered, but not the date when the money is received. So for example, we have received some advance for any services. We will not take into consideration the date of advance receipt. Take into consideration only the date of service provided or the date of order delivered. See these examples. If a company receives an order on April 1st and delivers goods in the month of May and gets paid in June, the company has to record its revenue only in the month of May. Why? Because goods are delivered in the month of May, right? So this concept ensures that income is shown in the correct period, giving a true picture of the business financial performance. Next, matching concept is also called periodic matching of cost or revenue concept. So what is match expenses? What is matching concept? We have to match expenses with the related revenues in the same accounting period. Then only we can get the true profit or loss. In this example, the company is following January 1st to December 31st as accounting year, right? So here company sold some goods in the month of December. For this sales, the company also pays sales commission to sales agents, right? But that commission is paid in the month of January. That means that is next accounting year. So how the business should show in their books that commission, whatever is paid in the month of January, cannot be shown in January month, but it should be shown in the month of December. Why it is to be shown in the month of December? Why? Because sales are affected in the month of December. So all the sales related expenses are to be shown only in that particular month. Though the commission is not paid now, we have to show in December month as outstanding commission. What is outstanding commission? Amount is to be paid in future, or amount is due for the future. Is it clear? Next, what is accrual concept? Revenues are to be recorded in books when they are actually earned, but not when cash is actually received by the business. In the same way, expenses are to be recorded in books when they're actually incurred, but not when actually the cash is paid. For example, if you sell goods in March month, but you receive payment in April, so how you will record in your books? You will record only in the month of March because sales are made only in the month of March. So how you will show? You will show it as outstanding income. Is it clear? In the same way, you are paying electricity bill of June month in the month of July. But how you have to show in your books in the month of June? As outstanding expenses. Though you are paying in the month of July, you can't show in the month of July. You have to show only in the month of June. Next, objective evidence concept or verifiable concept. Always remember that we have to record only when we can prove with documents. Say if you take example of any diagnostic center, whenever we go for any tests, we'll show our doctor's prescription. They will record that whatever the tests are to be done for us, they will record everything, and they will give when we make payment, they will give us some receipt, right? So what is the evidence that they have received money from us? The receipt, whatever they are generating, that is the evidence. In the same way, whenever any salary is paid to the employee, company can show bank statement or the voucher that is signed by the employee as evidence. So always remember that unless and until any evidence is there, we cannot record anything into our books of accounts. Why? Because account records have to be accurate and trustworthy. Here there is one example. If a company receives rupees 10,000 from a customer, the accountant should record this transaction only when there is a bank statement or if any cash receipt. If there is no bank statement or cash receipt, then this receipt of 10,000 cannot be acceptable. In the same way, when we have purchased some goods, we have to show our invoices as evidence. So these evidences are also called what? Supporting documents for any payments or receipts. So we have covered all 10 accounting concepts, that is business entity concept, dual aspect concept, going concern concept, accounting period concept, cost concept, money measurement concept, realization concept, matching concept, accrual concept, and objective evidence concept. Next, we are going to accounting conventions. What are accounting conventions? Those are called our customs or traditions or usages or practices, whatever are followed by accountants. When there are no fixed rules are made, accountants follow some customs or traditions. Those are called the usages of the accountants, which generally will also follow in our business. These are all the common practices or guidelines that are developed over time to deal with different situations when our rules are not clear. So the usual ways accountants handle their accounts when they are facing unclear situations are called accounting conventions. What is convention of consistency? We have to follow consistent methods in our accounting every year. These methods are to be remain unchanged from one accounting year to another accounting year, so that only we can make comparison easily. If there are any changes because of some reasons, then that we have to show as a footnote in our books of accounts. If your company is following one depreciation method, the same method is to be followed every year. So for example, we are following straight line method. If your company is following straight line method, it should follow consistently the same straight line method. But if the company is changing the same year, 6 months straight line method and other 6 months diminishing balance method, then we cannot compare our accounting properly. So that is why company has to follow the same method. What is straight line method? If the machinery value is 1 lakh and the life of the machinery is 10 years. So 1 lakh divided by 10 years means every year how much amount will be depreciated? 10,000. So every year we will depreciate rupees 10,000. This is called what method? Straight line method. What is diminishing balance method? What is diminishing balance method? If the company is depreciating its assets every year by 10%. Say the value of the asset is 1 lakh. So 10% of 1 lakh is how much? 10,000. So 1 lakh minus 10,000, 90,000. And next year also 10% of 90,000, not on 1 lakh. So 90,000 into 10%, 9,000. So 90,000 minus 9,000, 81,000. Next year, again 10% on 81,000. So like this, if you're calculating depreciation, it is called what? Diminishing balance method. Is it clear? If the straight line method is followed by the company, follow the same straight line method consistently. Or if you want to follow diminishing balance method, you follow diminishing balance method consistently. Or because of any reason, if you want to change the method, then change the method and show that as a footnote in your accounts. Convention of disclosure. What is convention of disclosure? In our accounting, all the material facts must be disclosed in our financial statements. Means all our stakeholders should know what are the important information is there that should be known to the stakeholders, because stakeholders should not be misled. Say for example, we'll write sundry debtors in our assets, right? Sundry debtors means to whom we are selling our products. So these products are sold to our customers on credit basis. We have sold 10 lakhs worth of products to our customers. So out of the 10 lakhs, 8 lakhs will definitely receive from our customers. So what is the debt is called? Good debt. And what is the remaining amount? 2 lakhs. Out of the 2 lakhs, 1,50,000 is doubtful. We may receive or we may not receive. We are not having any clarity about that. So what is our doubtful amount? What is our doubtful debts amount? 1,50,000. And the remaining 50,000 is bad debts, means which we cannot recover. So this we have to show in our books. So how you will show in our balance sheet on asset side, how you will write sundry debtors 10 lakhs minus doubtful debts 1,50,000. So how much is remaining? 8,50,000. Okay, minus bad debts. How much is remaining? 8 lakhs. So what is 8 lakhs? 8 lakhs as good debt. So like this, we have to show in our books to have clarity about our sundry debtors. Next, convention of materiality. What is convention of materiality? We have to record only very important information in our books. We should ignore all tiny information. Unimportant things can be merged or it can be left out. For example, stationery. What is stationery? Buying files, books, pens, pins, staple pins, staplers, writing pads, papers for printouts. So for all these purchases, we can't have separate accounts like pens account, pencils account. All this information is immaterial. No, it is not required. So that is why what we should do, we should merge everything into stationery. Instead of writing pens account, pencils account, you just show as stationery account. At this point, you have to remember which won't affect our decisions. Either we can ignore that or we can merge with others. Next, convention of conservatism. This is very important. What is this? Playing safe principle. What is playing safe principle? We should include all expected losses or all possible losses in our books, but we should not enter unrealized or unearned profits, because anticipate no profit but provide for all possible losses. Here you can take one example. Valuation of stock at cost price or market price, whichever is less. See, we are taking the principle of convention of conservatism here. We have to show stock as either at cost price or at market price, whichever is less. See, I've explained you cost concept. There, what I've explained, we have to show all our assets at cost price, not at market price. But only for valuation of stock, we have to consider either cost price or market price, whichever is less, because we cannot inflate our price and show more in our books. Next, making provisions for doubtful debts. See, for any doubtful debts, what we have to do, we have to make provisions. If we receive that amount in future, it's good. Suppose we have not received that amount in future, then we can adjust this amount for the doubtful debts. See, this convention of conservatism, this we will implement in our life also. Say, for example, if we are earning 1 lakh rupees per month, what you will do? You will spend 70,000. So you will save the other 30,000. Why you will save? Because if any necessity occurs in the future, we can use this amount. So we will revise once. Accounting principles are divided into two. One is accounting concept, another one is accounting convention. What are accounting concepts? The basic rules or ideas for recording our business transactions into our books. We have to follow the same rules when we are recording our business transactions in our books. What is accounting convention? These are the usual practices or traditions that are followed by our accountants previously, because when we are not having rules, we'll follow the traditions or usages or customs followed by previous accountants. So this is called accounting convention. This accounting concepts and conventions, this topic is very important. This you can get either as essay question, or you can get concept wise or convention wise in short notes. That's all for today, but learning never ends. Thanks for watching. Please like, follow, share, and subscribe for more videos. See you in the next video. Thank you.